If you feel lately the market's sending mixed signals, well, you're not alone. If it feels as though the stock market trend just simply runs out of gas rather quickly, there's a reason for this. Today's news is a perfect example as to why this is happening. Earlier today, PPI Producer Price Index was released on a year over year basis, 2.4%. It's the highest high in the past several months. On a year over year basis, producer prices, which are those prices that the manufacturers pay for raw materials, they are rising. Excluding energy, producer prices are rising even faster. This is core PPI on a year over year basis, now at 3.1%. It's the highest number in the past 4 months or so. And again, excluding energy, we're seeing higher prices for manufacturers for the raw materials. And it's thought that if the manufacturers have to pay higher prices for raw materials, the consumer prices eventually will follow. Speaking of consumer prices, yesterday we spoke about the CPI. Most measures of consumer prices are rising except for gasoline and fuel oil, down a lot, down about 12% each. There's actually a very ominous reason why this could be happening. We spoke about it yesterday. But comparing the two, CPI versus PPI, we can see here core CPI, that's excluding food and energy on a year over year basis. We've been around 3.3% for several months now. However, producer prices also on a year over year basis continue to rise. So we're seeing the PPI rise while consumer prices stay flat. This is a warning sign, perhaps, that consumer prices again in the future could follow. Now, the Treasury market tells us really what the Fed's path is. In particular, we see here the different maturities from the 1 month up to the 30 year. Notice that the lowest yield is available on the 3 year maturity. And there's a reason why this is happening. It's telling us that rates are expected to decline, but slowly. You see, the short term maturities like the 1 year, the 6 month, they move closest within expectation of Federal Reserve decisions soon. Those rates are still high. This tells us the Fed is not ready to cut rates quickly right now. Over the long term, we'll see lower rates. However, looking at the longer side of the maturity scheme, longer term economic projections do look good. For example, the 10 year to 443, it tells us further out we see rosy economic conditions. And we see at the moment very little chance the Fed is going to cut rates aggressively. Over the medium term, they will, but not immediately. These are the mixed signals. Now the Fed, they want to cut rates very slowly. This was earlier today. In addition to the PPI, Chairman Powell said, solid economy allows the Fed to consider rate cuts carefully. In particular, he said, the economy is not sending any signals that we need to be in a hurry to lower rates. This kind of flies in the face of what we've been taught lately by the Fed and their speak that they wanted to be more aggressive to cut rates. This seems to be a different tune. Here's another example of how shocked the market was. In blue, 1 year treasuries. In yellow, 10 year. Notice what happened. Yesterday we had the CPI. It was a pretty benign number. There was a 431 yield on the 1 year bond. Today, a 436. Again, the short-term maturity bonds like the 1 year, they move closest with the expectation of rate cuts. Based on Chairman Powell's speech today, there's a little bit less of a chance that the Feds are going to cut rates soon, and that's why the short-term maturities ticked up. Long-term maturities, those 10 years, they didn't move at all because what he said today really did not speak to any long-term economic projections. Here's another piece of evidence that speaks to the same, notion. In blue, 425 to 450, those are Fed funds futures. The blue bars show us a probability in the December meeting, by the way, that the Federal Reserve will cut by a quarter. Blue is a quarter point cut, red, no cut. Notice what happened in the past couple days. CPI was released yesterday. There was an 83% chance the Fed would cut by a quarter in December. Now, based on the PPI, but more importantly, based on Federal Reserve Chairman Powell's speech, There's now only a 59% chance the 1 year Treasury yield ticked up. The Fed funds futures for a rate cut ticked down. He's pulling back the reins on the possibility of a rate cut. Now, a new definitive trend will emerge only when the market gets clarity. If you've noticed over the past, several days, weeks, that the market seems to have a very push pull, up one day, down the next type of, pattern, it's not an accident. It's because there's mixed signals all over the place. Just in the past 2 days, two inflation reports plus Federal Chairman Powell speaking. We had on one side expectations the Fed was going to be more aggressive, now less aggressive. And until we get more clarity, choppy markets could be in our near term future until all the buyers and sellers line up on one side or the other. We hope this has been helpful. We look forward to seeing you back soon.